Welcome to Talking to Experts. I'm your host, John Charbonneau. As retirement inches forward for thousands of Canadian baby boomers, a number of retirement planning questions need to be answered, and how best to use the equity they have built in their home comes to mind. One option to improve the quality of their retirement by accessing this equity could involve the use of a reverse mortgage. In this episode of Talking to Experts, we spoke with a reverse mortgage specialist and asked him what are the differences between a traditional mortgage and a reverse mortgage.
That's a really good question. Sometimes it's important to think about what the similarities are before we highlight what the differences are. So some of the similarities between a traditional mortgage or a home equity line of credit and a reverse mortgage is they both require that the home be maintained and kept up in good condition. They also both require that home insurance is kept up to date. And they also require that property taxes are looked after each year. Now we're lucky in BC. We have a program that seniors can use to defer their property taxes, and it's a really good program they should look into. Another really important place that a lot of people don't think about is we're governed by the same organization. It's called OSFI. It stands for the Office of the Superintendent of Financial Institutions. And because we're governed by the same thing, we really have to offer the same protections that a client can get at their local bank or through their local mortgage broker and a typical lender. Those things are really important, and it really kind of starts to highlight where we shine, and that's where the differences come in. With a traditional mortgage or a home equity line of credit, there's going to be a required payment every single month, whether it's principal and interest or just interest only. With a reverse mortgage, there's no payment required. It's 100% optional. And that's important because in retirement, cash flow becomes the #1 priority for most retired seniors. The second biggest one is lowering of risk. A traditional mortgage or a home equity line of credit has some inherent risks, which are really overcomable when you're in your working years. So they're called something called demand loans, which means when your term is up, it's a renewal. With a reverse mortgage, you're approved for life. It's a lifetime approval. So it's not a renewal at the end of a term, it's a reset. It's just selecting a new rate, very simple. That offers that lifetime protection for that senior so they can actually plan out what their retirement's gonna look like. The last and probably the biggest one that stands out is there's some protections in place that just don't exist on traditional products. There's something called a fair market value guarantee. That means that the client can rest assured that they'll never be in a negative equity position when it's time for us to be repaid. In fact, 99% of the time, there's more than half the equity left for the client to use for themselves or to pass on to their estate. There are two types of reverse mortgages that are available to Canadian seniors. The first one is the CHIP reverse mortgage. CHIP is an acronym that stands for Canadian Home Income Plan, which was the original name of the company when it was founded 30 years ago. We became a bank in 2009, and we're now called Home Equity Bank, and we are the only providers of reverse mortgages in Canada. About 2 years ago, we launched a new product, a second reverse mortgage called the Income Advantage. I like to call it a cash flow solution because it's the one that allows a senior to tap into the equity in their home on a monthly basis. Okay? Those two products together in the marketplace, whether somebody is house rich and cash poor or they're mid to high net worth, they can put plans in place with their financial planners and advisors to really make their retirement shine. A reverse mortgage is available to Canadians that are 55 and older. Our sweet spot though seems to be about 65 to 85, but if you're a homeowner, whether it's a house, a townhouse or a condo, or you're looking to purchase a retirement residence, your application is in good hands. No, it's a simple answer. If we step back to an earlier question when we talked about some of the similarities, a reverse mortgage is really just a mortgage that gets registered on title. We're paid back when the house is either sold or the last applicant has passed away. When you sell your home, we're simply repaid from the proceeds of the sale. The balance goes to the homeowner. A homeowner is not required to take all of the funds up front. They can take some, what they need now, and save the rest for later, and it'll be there for them for the future.
It's impressive to see how the right expert can make a positive experience in your retirement. Are you hoping to learn more about your retirement options? Are you ready to take action? Just call our featured expert at the number on your screen. Thanks for watching.